Okay, let's move on. So, as we were discussing, the formula to compute the income tax expense is you have your income tax payable or refundable, plus or minus your change in deferred income taxes, and that's going to give you your income tax expense or benefit. So it's exactly the formula we've just been talking about. In the income statement or in the notes of the financial statements, a company should disclose the significant components of income tax expense. So this is just basically a GAAP rule that says that in your note, you have to put the difference between a deferred and the current section of your income tax. And this is the example of the presentation, which we've seen in previous examples. You're just breaking out what's your current component and your deferred component to total your total income tax expense for the year. Remember, financial statements, the more information you give your end user, the better it is for them to understand your business. That is the whole purpose between GAAP reporting, is so the end user really understands your business and can decide whether they want to invest in your company or not, whether they want to lend money to your company or not. That is the purpose behind financial statement reporting. So as we discussed, we have temporary differences, which are taxable temporary difference is your deferred tax liability, and your deferred tax asset is a deductible temporary difference. Sorry. These are just examples of where you would have temporary differences in income. So it's just giving you a couple of examples here. Sales accounted for on an accrual basis for financial reporting purposes, or on the installment cash basis. So you know how you're asking why do you have differences? These slides are just basically telling you these are some of the differences that you can have. If you want to understand more, this is where it goes. I have mentioned this to you. GAAP requires you to be on an accrual basis. Sometimes on tax you can be on a cash basis. So you'll have what's called temporary differences. Contracts accounted for under the percentage of completion. This is when you get to construction accounting. Investments accounted for under the equity method for financial reporting purposes. Gain on involuntary conversions of non-monetary assets, and unrealized holdings and gain for financial reporting purposes. So these are just some examples. On the expense side, you can have differences on product warranty liabilities, estimated liabilities related to discontinued operations, litigation accruals, bad debts, stock-based compensation, and unrealized holding losses. Other examples here, depreciation, deductible pension funding, prepaid expenses that are deducted on the tax return when paid. So a lot of times for tax purposes, prepaids you don't take into account prepaids. You actually deduct it when it's paid. So originating temporary differences is the initial difference between the book and tax, and then you have your reversing differences. So we've gone through all this through all the slides. So the first time it happens, it's considered an originating, and then as the years go by and you start reversing it, you have your reversing differences. As I had mentioned earlier, permanent differences. So permanent difference results from items that enter into pre-tax financial income, but never into taxable income. So it never reverses. That's what's considered a permanent difference. It only affects the period in which they occur. They do not give rise to future taxable or deductible amounts, again, because they don't reverse. That's why they're considered permanent. There are no deferred tax consequences to be recognized. Some examples of permanent differences are interest received on state and municipal obligations, and I'll give you an example. If you get hit with a penalty from the IRS and you have to pay a penalty to the IRS, for tax purposes, that's not a deduction. You cannot take a deduction for that. So if you pay the IRS $10,000 in penalties, you don't get a benefit for that. So for book purposes, you'll get a $10,000 deduction because you paid the penalty, but for tax purposes, you don't. Proceeds from life insurance carried by the company, premiums paid for life insurance carried by the company on key officers. So if you pay life insurance for one of the officers, let's say for the president of the company, you pay a life insurance policies, you can't deduct that for tax purposes. So you don't get a benefit for that. But you would want, as a GAAP reader, you would want to know if they pay that because that's a significant amount of an expense. So you'd want to see that on your GAAP financial statements. So that's an example as well. So all of these are permanent. They never get reversed. At no point in time will you get the deduction for that. So do the following to generate future deductible amount is the deferred tax asset. We discussed that. Future taxable amount, deferred tax liability, and permanent differences. Just different examples. So basically here it's just giving you different examples, and I don't want to take time going through this because if you want to go back, you can go through the slides. It's on the blackboard just to kind of test yourself to know, is it a future deductible amount, a future liability amount, or a permanent differences. It's just giving you the different examples for you to understand what it is. You see, proceeds received from a life insurance company because of the death of a key officer is considered a permanent difference. All these slides are doing. So as an example, Havachi Company reports pre-tax financial income of $80,000 for 2017. The following items cause taxable income to be different than pre-tax. Depreciation on the tax return is greater than depreciation on the income statement by $16,000. Rent collected on the tax return is greater than the rent earned on the income statement by $27,000. Fines for pollution appear as an expense of $11,000 on the income statement. Havachi's tax rate is 30% for all tax years, and the company expects to report taxable income in all future years. There are no deferred taxes at the beginning of 17. So here are the different examples, okay? So I'm gonna pull up the solution and we'll walk right through it. Okay. So basically it told us what our financial income was at the beginning of the year. It gave us 3 examples of differences. It gave us one as a deferred tax asset, one as a deferred tax liability, and one as a permanent difference. Easiest one, permanent difference, $11,000. If it's permanent, it never reverses. That's why you don't see a reversal here. The other 2 reverse, one is an asset and one is a liability. So you start off with your book income, you're going to get down to your taxable income. So in the first year of 2014, you're going to have $102,000 of taxable income, your tax rate of 30%. You have income tax of $30,600. And then you have your deferred tax asset column and your deferred tax liability column. Sense? Future tax rates. So some tax rate considerations you have to take into effect is the future tax rate, exactly what you had mentioned earlier. As you go into future years, you're going to have different tax rates because you may be profitable one year and one year maybe you may have losses. So you're going to be shifting in different tax rates. So it says a company must consider presently enacted changes in the tax rate that become effective for a particular future year when determining the tax rate to apply to existing temporary differences. In determining the appropriate enacted tax rate for a given year's company must use the average tax rate. So if you don't know what the future tax rate is going to be, it tells you need to take an average of that tax rate. When a change in the tax rate is enacted, companies should record its effect on the existing deferred income tax account immediately. So if there's a change in future tax rates and you've already calculated your deferred tax liability, it is telling you that you need to go back and recalculate what the new tax rate is going to be and fix your deferred tax account. So if the government changes your tax rate, now your deferred tax asset or deferred tax liability changes because you now have a different tax rate. You need to go back and change it. A company reports the effect as an adjustment to income tax expense in the period of the change. So let's say we did our calculation in 2017, right? For 2018, for 2019, 2020. We're in 2000, let's just say 19, and now my tax rates change. I need to go and adjust 2020 for the new tax rates.
In
the future years, correct. But you do it in 2019. If I know my 2020 tax rate is changing, in 2019, I have to calculate it with the new tax rate and fix it in my 19 balance sheet.
But you don't have to change in the past.
No, you don't go backwards. You go forward. Yeah, your balance sheet is going forward to the future. All right. So NOLs. Sorry, I say NOLs because that's how I know them. Net operating losses, I'm going to refer to them as NOLs. That's what it stands for. It's basically tax deductible expenses exceeds taxable revenue. So the federal law permits taxpayers to use losses of 1 year to offset the profits of other years. So again, you can either carry your losses forward or you can carry your losses backward. By law, by the IRS law, you're supposed to carry it backwards 2 years. You have to make an election to the government that says, I don't want to carry it back 2 years, I want to carry it forward. If you fail to make that election, you don't have the option. You don't have the option. So let's say if you don't get a benefit for carrying it back 2 years because you already had losses, you basically lose that loss, you lose it from carrying it back 2 years. So you have to remember that whenever you work on taxes, if you have an NOL, you have to make an election if you do not want to carry it backwards. So, back 2 years, forward 20 years. Losses must be applied to the earliest year first. So when you carry it back 2 years, you don't get to pick what year. You don't get to say, okay, I'm going to put, let's say you have $10,000. I'm going to put 5,000 here, 5,000 there. It doesn't work that way. You have to first carry it back here, and if there's any losses left, then it carries forward to the next year. Does that make sense? If after you carry it back 2 years, you still have more losses left, you ate up all the profit here, you ate up all the profit here, then you start carrying forward. Okay? Again, if you decide to relinquish carrying it back 2 years and you make that election to the government, then you just carry it forward. And why would people do that? Do you have an idea why anyone would give up carrying it to a prior year? Depends what tax rate you're in. If you're in a higher tax rate here, why would you want to carry it to a year that you're in a lower tax rate? You're going to give it up, you're going to relinquish it, and you're going to say, no, I want to carry it forward because I got a better benefit carrying it forward. That's why people would do that.
That is for the people or for the corporation?
For a corporation. But people, I say like the individual, the accountants. The accountants make that election to give it up. So I would do that. I would advise my client. I would run calculations whenever a client had a loss. I would run calculations to see what benefit was for them to either carry it back or carry it forward. And I would advise them, this thing you shouldn't carry it back because you're at a 15% tax rate. But you know what? In the next year, you're going to be in a 30% tax rate. So let's carry your loss forward so you go down in tax rate. You get a better benefit. You run these analyses to help them out. So Common Corporation had the following tax information. So here's the taxable income, tax rate, taxes paid. In 2018, Conman suffered an NOL of $480,000, which it elected to carry back. So it's going to take this loss and it's going to carry it back. Again, you're going to start in your first year. You start here and then you start going down. Okay? The 2018 enacted tax rate is 29%. Prepare Collins entry to record the effect of the loss carryback.
Being in 17, you can carry back to all the way to 15.
2 years back, correct. So you can go back to 15 and 16.
You need reverses all the
Tax returns. There's one page, and I don't remember the form off the top of my head, but there's one form that shows the different tax years, and that one form goes in front with your amended tax returns behind it. You have to. It's a long process because you have to prepare all those tax returns all over again. But usually you have there's these very complex accounting programs like tax software programs that really help you drop in the numbers everywhere it goes, and you as the accountant have to check everything to make sure that the system did it correctly.
For example, what kind of situation can put a corporation in that kind of decision, like going back, carry back 2 years?
So like I said, so let's say in 2000, here, for example, here. So you had $480,000 loss. You're going to analyze whether it makes sense to take the loss in 15 and 16, or instead to carry it forward, because you may be in a lower tax bracket these years than you are in future years. So usually when you're doing this, you're filing your current year tax returns a year after. So you're already in 19, for example, right? When you're doing your 18 taxes, you're already in 19. So you more or less can tell what tax bracket you're going to be in the future years. So you may make a decision not to carry it back because you're already in a low tax bracket. So if you had a little bit of profit in these years, it probably doesn't make sense to carry it back if you have a lot of profit in future years, because you're gonna be in a higher tax bracket. The more profit you have, the harder you start moving up in tax brackets.
And that year, for example, what for 6,000.
You can go all the way from 10% to 40% in tax brackets, depending on your profit.
And the year 12,000.
So if I'm here and I have 10% tax here, and I'm here 15%, but I know that in 2019, I'm gonna be in the 35% tax bracket, I wanna carry my loss over here, because I wanna bring that tax bracket down, I wanna make my profit lower. The higher your profit, the higher your tax bracket. The more money you make, the more taxes you pay, pretty much. That's where it goes, always. So you run all these type of analysis to try to figure out what's the better year to take the benefit in. And again, the only thing that's not beneficial is that you can, when you carry it back, you can't decide. Like you can't say, well, you know what, I just want to carry it only 1 year. I only want to take it to 2016 and then go forward. No, you can't make the decision. If you decide to carry it 2 years back, you're going 2 years back and whatever here. And if you have anything left over, it goes into 16. You don't get to pick and choose your years. Okay? So, in this example, you have taxable income in 15 of 300, 16 325, and 17 400. And then you have a loss of 480 in 2018. This client decided they're going to carry their loss, carry it back. So they're going to go back 2 years, right? So what do? They take their 480, the first 325, remember, you have to start the first of the second years, of the 2 years. So 325 goes here, they just ate into 325 of here. What were they left with? 155, the 155 goes into 2017. So they were able to take the benefit of this loss 2 years back. And this is the tax rate and their tax advantage. So, in this situation, they got $105,000 and $73,500. The government will send you a check back for that amount. When you file these NOL carryback returns, that's what they're called, the government will send you a check back for that tax that you paid those years, a physical check. It was great. When the economy crashed in 2008, I was filing these net operating returns left and right. Everyone was getting checks from the government back. Because what happened, the economy did great all those prior years, and then the economy crashed. Everyone started losing money, and all these businesses were carrying back to get all their tax money back, of money that they lost. For a couple of years, it happened. That's why taxes is a great career to choose, because even if the economy is good or bad, you will always have a job.
Oh, 480.
I'm sorry, refund. I'm sorry, the refund is the 97.5 and the 46.5.
480, you have to deduct the year, but 325 on the rest.
Goes forward. So you take it on the first year, and then goes forward. So this is the income tax they paid with the new tax return, their amended tax return. There was no tax due here, so they get this 97 back. And this 120, they would have owed 73.5. So the difference between the 120 and the 73.5 is the 46,500. So you're getting a check back for $144,000 from the government. Now, had this number been higher and this would have gone into the full 400, then you would have kept going forward. And you save it. You can, so obviously you're not filing your 19 return yet. So you keep a form that keeps track of how much money you're carrying forward. And usually taxpayers that have huge NOL losses are clients that invest in real estate. Why? Because of depreciation. Depreciation causes large amount of losses on tax returns, and those losses keep carrying forward and carrying forward and carrying forward. That's why they say Mr. President hasn't paid any taxes, because he invests in real estate, and in real estate, you have a lot of NOL losses due to depreciation. And this is your journal entry. So basically your journal entries, you're gonna record the receivable on your balance sheet. So income tax receivable of 144, and you're gonna have on your income statement benefit due to loss carryback of 144,000. So that's the only thing is you have to pick this up in income, the 144 you're gonna get back. But why? Because you took the deduction for the expense when you paid it. I'm sorry? Mm-hmm. When they say what, like specifically what? Correct. I'll tell you, my client, my boss that I work for, he is very big on real estate as well, and pretty sure he doesn't pay taxes in about 10 years. Because real estate, there's this thing called accelerated depreciation, which is an IRS component, where the IRS lets you accelerate depreciation on certain things. So if you keep buying and you keep buying, you keep accelerating depreciation, and depreciation is an expense that offsets your profit. So as long as you're constantly buying real estate, you're gonna have all these losses. It's pretty interesting. That's why there's tax planning. Okay, so Road Inc. incurred a net operating loss of $500,000 in 17. Combined income for 15 and 16 was $350. The tax rate for all years is 40%. Road elects the carryback option. Prepare the journal entries to record the benefit of the loss carryback and loss carry forward. So we had 500,000, right, of a loss. So we're going to carry it back to the 2 prior years. You had 350. So you're going to have the 350 is going to off the 500. It's going to leave you with 150. Your income tax revised is 60,000 down here at a 40% rate. Your journal entry then is 140,000. You're going to have a debit to income tax refund receivable of 140,000 and a credit to income of benefit due to loss carryback of 140,000. Pretty much the same example we just did. The remaining amount that you're going to use in the future that's left over from the NOL of 60,000, you're going to record as a deferred tax asset. Why? Because it's a benefit to you in the future, and benefit due to loss carry forward of $60,000 is your credit. So this is the remaining NOL that you have left that you're going to use in the future.
Why this the second year, like which is kind of the first year, always give you like income tax or income zero, like the values are exact.
So because this was your income, right? When you have 500,000 of an NOL, you can only zero out your taxable income. You can't go more than that. So you're gonna zero this out up until, if this would have been less, if this would have been 200,000, then you would have put 200 here and you would have had 150 down here. Okay? So you're taking from your 500, you're gonna eat up the profit of the prior year, but you're still gonna have remaining NOL left. In this case, you have 150,000 left to use in future years. So now when you file your 18 taxes, if you have $150,000 profit, it will eat into your NOL, the remaining NOL. Okay? So basically all you're doing here is, since GAAP is requiring you to present on your financial statements that you have a future benefit coming to you, so that your financial statement reader knows that you have this benefit coming forward. Okay? Road Inc. incurred a net operating loss of 500 in 2017. Combined income of 15 and 16 was 350. Road elects the carryback option. Assume that it is more than likely than not that the entire NOL loss carried forward will not be realized in future years. So where this is going now, remember how we spoke about valuation allowance? Where this is going out, talking about valuation allowance. But it's basically telling you that they believe more likely than not that they're not going to use that 150 that was left over. They're not going to realize it in the future years. So now we have to create a valuation allowance for that. So these were the original journal entries that we booked. There's your valuation allowance. So in the first problem we did, this was our answer. These were the journal entries we did. Remember how we booked the future benefit of 60? That problem just told us now that chances are they're not going to use it. So here's your entry that you need to book that valuation allowance.
Because they don't want to carry it forward.
Because there's a more than 50% chance that they're not going to utilize it. So if a business, again, if a corporation believes that they're never going to get the benefit of that, let's say they're, I don't know, this business believes that in the next 20 years it's not going to have any profit. So it's going to say, we're never going to get the benefit of this $60,000. So that's why they record this entry. That's usually not the case, but it's a GAAP rule. It says if you don't believe you're going to use it, you need to record for it. So just again, valuation allowance revisited, whether the company will realize a deferred tax asset depends on whether sufficient taxable income exists or will exist within the carry forward period. It's exactly what I said. If they don't think there's going to be any profit for the next 20 years, that's why they do these valuation allowances. Okay. And the last section. So now we're just going to basically go over the presentation of everything we've just done in this chapter, how it gets reported on the financial statements. So balance sheet. Income tax payable and income tax receivable are reported as a current liability or current asset, respectively, on the balance sheet. This is all going back into basic intermediate accounting 1, where things get reported on your balance sheet. Companies should classify deferred tax asset as a net non-current amount on the balance sheet. So they want you to record what's current and non-current. So to illustrate, assume that Scott Company has 4 deferred tax items on December 31st as shown in the following table. So you have all these differences of assets and liabilities. It's going to have a net liability of 205. On the income statement, the companies are required to report income before income taxes and income tax expense on the income statement. PepsiCo reported the following amounts related to tax expense. So again, it's just, this is all presentation. You're going to have on your income statement, your income before income taxes, and then your provision for income taxes and your net income. So they just want you to break it out. They don't want you to combine it all. And always know that this always comes after your income. Like first it goes your income and then income after taxes. You know from intermediate accounting 1. FASB believes that the asset liability method, sometimes referred to as a liability approach, is the most consistent method for accounting for income taxes. So basic principles, going back to intermediate accounting 1. A current tax liability or asset is recognized for the estimated tax payables or refundable on the tax return. This is what we started talking about the first couple slides. A deferred tax liability or asset is recognized for the estimated future tax effects attributable to temporary differences and carried forward. The measurement of current and deferred tax liabilities and assets is based on a provision of the enacted tax law. This is what we just discussed a couple of slides back, if the tax rate is going to change. And finally, the measurement of deferred tax assets is reduced by the amount of any tax benefits based on the available evidence that are not expected to be realized. Valuation allowance, we just discussed as well. So this is just an illustration on how to compute and report the deferred tax income. So you identify the amounts and type of existing temporary differences in carry forward, and then you're going to determine is it a tax asset or is it a tax liability. If it's a tax asset, you're going to determine deferred tax asset. You're going to determine is there a valuation required. So it's just the same steps. What goes on your balance sheet and what goes on your income statement. Summary of all sides we've just gone through. And that's it. I don't go through the appendixes. Do you have any questions? Any concerns? If you have trouble doing the homework and you need to speak to me, remember, there's an online component, which is on Friday, that I can make myself accessible, I can send emails, I'm available for any, it's posted on Blackboard.
I saw